Welcome back, investors, to Ticker Time News. I'm Adam, and today we're talking about 3 risk management techniques that professional traders use to protect their profits. This is a video that every trader should watch, so you know how you can protect your profits. When investing, it is best to have a strategy. Risk management is a key part of any profitable strategy. We're going to take a look at what active investors do to protect their profits. If you are an active trader in the stock market, you need to take a proactive approach to risk management. The stock market can be a phenomenally profitable place to invest. But if you just have a handful of your stock picks end up losing, you could end up with far fewer profits than you might have otherwise had. By adopting a proactive risk management strategy, you can reduce the downside risks of the stock market while still enjoying the upside potential. But how do you adopt a risk management strategy? And what should that strategy include? Without a sound risk management strategy in place, even the most seasoned investor could lose all of their profits in just one bad trade. Active investors are most in need of a risk management strategy since their frequent trading puts them in greater danger of the occasional bad trade. Your risk management strategy should include a number of factors, and those factors are what we're getting into right now. Planning your trade. Every active stock market trader needs a plan, and it is important to plan your trades carefully. When you buy a stock, you need to think carefully about why you are making the trade. Do you believe in the company and plan to hold the stock for 5 years, 10 years, maybe 20 years? Or are you looking for a short-term trade? It is also important to think about why you might sell the stock. Do you have a specific price point in mind? Or do you plan to play it by ear? Planning your trade ahead of time will make your investing life easier and reduce the amount of risk in your portfolio. There's the idea, buy the rumor, sell the news, in investing that many base their trades on. I'm sure you've heard the idea. This idea is a market adage based on the belief that the stock prices move in anticipation of rumors and rebound when profit taking occurs after the actual news is released. This can be a risky strategy. Look at how many investors lost money on Workhorse. Workhorse was pure speculation, and many YouTubers thought that Workhorse would get at least some percentage of the USPS contract, but they got zero. A lot of smart investors, a lot of seasoned investors made a quick profit and left many of you holding the bag. I just want you to know that this can be a risky strategy for most stocks, but many growth stocks do have a cycle that follows this adage. Workhorse is the perfect example of the buy the rumor, sell the news. This isn't to shame or blame. This is just a learning opportunity. Take profits as they come. Stock market investing can be extremely profitable, but too many investors have watched their profits slip away. If you want to reduce the inherent risk, you need to take profits as they come. Tracking your investment results and reaping profits when you can should be part of any risk management strategy. You do not have to sell your entire position, but looking for an exit point for your riskiest holdings makes a lot of sense. Another adage is lock in profits and play with the house's money. Jim Cramer on Mad Money often tells new investors to do exactly this, especially if a stock has run up too far and too fast. What this means is that you take out your cost basis and leave your profits or the house's money in the trade. Traders and investors lock in profits for many different reasons, and oftentimes it's to reduce risk. Long-term investors may lock in profits to maintain their portfolio balance. For example, any investor may have started with a portfolio divided equally among 5 stocks. If one stock outperforms, its portfolio allocation might grow from 20% to 30%, which exposes the investor to added risk. The investor may lock in profits for a portion of the outperforming fund or stock and redistribute the proceeds among the other 4 stocks to maintain an ideal portfolio allocation that minimizes risks and maximizes profits. Many actively managed ETFs, like Cathie Wood's ARK Invest, rebalance their portfolios frequently. That's why, if you get their nightly email, you may see that they bought 200,000 shares of Tesla. But the very next day, maybe they sell 10,000 shares of Tesla. That's because Tesla's price increased and it expanded out of their portfolio allocation for Tesla stock. ARK Invest then sells that 10,000 shares to rebalance their portfolio. It's very common. It's nothing to get all worried or nervous about. It's not like Cathie Wood and ARK Invest are abandoning Tesla because they sold a few thousand shares. No, it's just rebalancing their portfolio. Short-term traders often lock in profits to generate income and reduce risk. For example, a trader may open a long position after a bullish earnings announcement with a series of price targets. After the stock reaches the first price target, the trader may lock in profits for a third of the position size and continue to hold the other 2/3 of the position until a higher price target is reached. This way, the trader is taking some money off the table and reducing their risk if the stock were to suddenly turn lower. Set a stop loss. Even the most successful investors do not always hit a home run on every trade. If you play in the stock market long enough, you will buy a few losers. That's okay. That's how the system works. That's how we learn. Setting a stop loss price for the stocks you buy is one of the most effective ways to reduce your risk and cut your losses. You can approach the stop loss process in a number of ways: the percentage method, the support method, and the moving average method. We're going to go over each method right now with an example to help you learn. Because remember, these videos ultimately are for your benefit. So I hope you're enjoying it. If you are, could you click that like button? And how about subscribing to the channel? The percent method. The percent method is by far the simplest way. All you have to do is determine the percentage of the stock price you are willing to lose before you exit your trade. This can be a percentage, say 5% to 30%. It's all about your risk tolerance. The support method. The support method is slightly more difficult to implement than the percentage method. To use this method, you need to be able to identify the stock's most recent level of support. Once you have done that, all you have to do is place your stop loss just below that level. For example, if you own a stock that is currently trading at $50 and you identify $44 as the most recent support level, you should set your stop loss just under $44. You may be wondering, why wouldn't you just set your stop loss for $44? The reason is you want to give the stock a little bit of wiggle room before deciding to exit your trade. Support and resistance levels are rarely accurate to the penny, so it's important to give the stock some space to come down and bounce back off of its support level before pulling the trigger. You don't want to exit your trade too early before a big bounce and then the big gain following the big bounce. The moving average method. The moving average method for setting stop losses is more simple than the support method, but it also allows you to tailor your stop loss to each individual stock. To use this method, you need to apply a moving average to your stock chart. Typically, you will want to use a longer-term moving average as opposed to a short-term moving average to avoid setting your stop loss too close to the price of the stock and getting wiped out of your trade too early. A 50-day moving average, or maybe even a 100-day moving average. When the stock reaches the moving average, a lot of times it acts as support and the stock will bounce off of it. That's why you don't want to use a short-term moving average, say a 20-day moving average or a 10-day moving average. Once you have inserted the moving average on your chart, all you have to do is set your stop loss just below the level of the moving average. For example, if you own a stock that is currently trading at $50 and the moving average is at $46, you should set your stop loss just below $46. Just as in the example mentioned before, using the support method, you should set your stop loss just below the moving average to give the stock a little room to breathe. Trailing stop loss method. The trailing stop loss is probably the most commonly used stop loss method ever. All you do is pick whether you want your stop loss to be a percentage based or a dollar based. For example, if you decide to set your trailing stop loss as a percentage based, let's say 5%, as the stock rises, your trailing stop loss moves up with the stock's price. So, if the stock goes up 20%, your trailing stop loss also moves up by 20%. Your trailing stop loss doesn't trigger until the stock falls by 5%. Either way, whichever stop loss method you decide to use, it should be an integral part of your risk management strategy. Some final thoughts. The stock market can be a great place to invest, but profits are far from guaranteed. If you want to let your winners run while trimming your losses, you need to have a sound risk management strategy in place. One that encompasses everything from stop loss to reaping the profits you have already accumulated. I hope you found value in this video. Make sure to smash the like button, click subscribe, and join our family of investors. Because ultimately, these videos are for your benefit. Thank you so much for watching. I will see you in the next video.
You can help out the channel and earn free money while doing it. First, earn $10 worth of Bitcoin by signing up for a BlockFi interest account and depositing $100. Plus, the added benefit to using BlockFi is that you will earn interest of up to 8.6% annually on your cryptocurrency. Second, earn 2 free stocks worth up to $1,850 by signing up to Webull and depositing $100. Click the links below to get started.